Another video that I'm going to record today. I'll probably have it up tomorrow morning only because 2 or 3 videos in one day is kind of a lot. But once again, beverage, I am over the age of 21, just to be clear. But we're going to be going over Chewy today, dog food company, stuff like that, pet products. Great company, great financials. Yeah, let's get into it. All right, Chewy. So recession-proof company, dog food. Everybody has to buy food for their pets, things like that. But we're just gonna go right into it here. So average cost of capital 11.4%. Not the greatest that I've seen on the higher end, but once again, I kind of just have this below 11% because that's like a general rule of thumb here. So I'm gonna give it the good old 0.5 only because it's kind of a case by case basis. Target price 31. We're at 27. Looks good there. Long term growth rate 36%. That is fantastic. Moving right along. All that looks good. The chart again also looks great. I mean, it's been underperforming the S&P 500, but I'll show you why I think that will be turning around very soon as we go into the income statement. Also, I'm doing the face cam for the video again. It might block some stuff, but I just kind of think it's a little more personable. But anyway, sales growth, we're seeing it. This is the quarters view, but even through the quarters, you could see it. Even seasonality even doesn't even seem to be a thing here, as it just increases every single quarter, which is fantastic. So full score there. Operating income, let's see it. Not a lot. Not a lot of operating income. Even net income. Now, the interesting thing here is net income is higher than operating, which you don't see very often. But operating income is getting there. I think they've just been growing a lot, advertising a lot, things like that. But again, it's positive and it's growing. So we're giving them the score for it. Just talked about net income. Full points there. Not a lot, though, compared to their sales. They have a ton of sales and not the most cost of goods sold. You would think that their net and operating would be higher, but the SG&A expense is kind of a little high here. But either way, positive, positive. That's all we need to see. EPS is growing. Looks good there. Total shares, let's see this. So it was growing, actually decreased. Let me switch to the years here. I don't think they've been public for very long. That's the only thing. So actually, yeah, they have. But total shares, let's see. I mean, it has been increasing, but not a lot. 398 to 432, 37 this year. I mean, I'm going to give it the 0.5 here because that's not the largest amount. It's not terrible. Let's move over to the balance sheet, see how that looks. So cash increasing a lot. They most likely probably took out a lot of debt, or they sold some equity this year, or just great earnings. We will see how that looks. Assets are increasing, always good to see. Short-term debt, almost none. Compared to their cash, almost none. Long-term debt, too. It does not look like it is necessarily decreasing, but what we're going to do there is do the good old 0.5 only because, again, it's not a lot compared to their cash, so that is no big deal. Retained earnings are negative, so I mean, not the best thing for investors, but I have it at a very low weight. Again, that's not the most important thing in the world. Going right into the cash flow, let's see what their operating looks like. Hoping for positive here. Yes, it is. So, I mean, everything looks solid there. Operating cash flow, good. Investing cash flow, should be negative. It's not. It looks like they have been selling investments or purchasing investments. I mean, oh, this is also the estimate for 2024. So let's move that out because that's not finalized yet. So it is negative for the finalized results. I am going to give them the point there only because I don't really go based on estimated results. So negative cash flow, that's good. Positive financing, not what I want to see. They have been, it looks like it's just other funds, which is a little vague, but again, positive investing cash flow. That's a 0 there. Or financing, sorry. Free cash flow, positive, growing, looks good. Now let's go to the use of cash statement, see what that looks like. Repayment of debt, negative. It's not really growing, but it is negative. Should be larger than the issuance, which they haven't issued any debt actually. So that's solid. Not the, I'm going to give them the point only because they have no issuance over the past 4 years or so. So that's good. Repurchase of stock, they have not done any as far as I can see. And it looks like they have never. So I'm going to do, I don't think they should get the point for that. So never done repurchase of stock, which isn't the best, but I'm sure they probably will soon. It's just a high growth, sort of a newer company in terms of being public, but we will see in the ratio. And now I could go into the segment history too. Let's see that. So, I mean, you could see very consistent, fairly high sales growth. That's always good to see. Let's go into the ratios, see what that looks like. Net margin. So their average is actually negative, but in the past 2 years, it has increased. I'm thinking it's very low, to be fair, but I'm thinking of half a point here because they have recently turned it positive, which is good. ROA, ROE, positive, was negative, now is positive and possibly going to stay that way. We'll see, but I don't know about the full point only because it's only 2 years worth of it, but we'll have to see in the next, I will go to the quarters here actually, see what it looks like on that. So honestly, on the quarters, it looks very good. So that they will get credit there. Let's actually look at the net margin on the quarter. So on the quarter view, net margin is increasing. It looks like it has been for about 6 quarters now. So honestly, I may give them full credit for that too, only because highest net margin we've seen in a bit and it's been increasing. So you know what? I will do full credit for that as well. And then let's look at the debt to equity. So that has been increasing. Let's go to the years for this though. Okay, so on the years, it has been decreasing, which is pretty good. Pretty solid. 5-year average is fairly low only because 2021 seems like it was rough for them. But yeah, I'll go with the credit for that. So overall, got an 81.5, 17.5 out of 22. That's not bad. I can also show, I'm still on DG here, but CHWY, their chart, based on their growth, their earnings, sales, things like that, their chart looks like it could be really good. They were at $120. They've seen consistent growth, solid sales. So I think they could be really good. Again, not investment advice. I'm not telling you to buy this, but it looks good from my standpoint. So 81.5 is a pretty solid score. And I think that's all I have for you. So kind of a quick one. I tried to go a little quicker for this, try to get the time down, but that is Chewy. Have a good one.